So very good afternoon. My name is Shekhar sir, and today I'm going to teach you the topic of economics. That is fiscal policy of India. Okay, so it is the fiscal policy of India, and we can also say this budget. Okay, तो इस वीडियो में हम लोग देखने वाले हैं बजट के बारे में. ओके, बजट क्या होता है, कैसे बजट बनाया जाता है. ओके, बजट के अंदर क्या क्या कंपोनेंट्स होते हैं, है ना. ओके, सो व्हाट आर द कंपोनेंट्स आर इन्वॉल्व इन दिस बजट. सो वी आर गोइंग टू सी ऑल ऑफ द टॉपिक्स हियर. ओके, सो budget. Okay, so what is budget? So if we see our household, so we can see that we are doing so many calculations in our daily life. Like if this is your household, if suppose this is your household, so what are the factors you consider? So in your household, you consider first your income and you consider your expenditure. Okay, so what is income and what is expenditure? Wait, let me change the color of ink. Okay, so first is income and second is expenditure. So suppose if your income is total 1000 rupees, so according to this 1000 rupees, you plan your expenditure, like you plan that you will okay, and 100 rupees you save for future emergency, right? So in our household, we always focus first in our income, and according to this income, we plan our expenditure, right? We plan our expenditure. But in the case of government, what happens? So in our budget, when we make our budget, so we have to understand the two most important topic first to understand the budget. Okay, one is asset and one is liability. So first we have to understand the asset and liability. What is asset and what is liability? Okay, so what is asset? What is asset? It means which helps us to generate profit in future. This is called asset. The thing which help you to generate profit in future. To help you generate profit in future. So what is the example of it? The example is TV and AC in electronic shop. You often visit electronic shop. What you see there? So before entering the electronic shop, first you see that is there any TV that is on or not. Okay, is there any AC? So in electronic shop case, the TV and AC is using for generate profit in future. Okay, so for business, if something help you to generate a profit in future, so that is called an asset. Okay, so that is called an asset. Like you can take your example, like in your house you use AC, you use fan, but that is for self consumption, not for any business, not for any profit generation. But in your shop, when you use TV or AC or fan, so that is for the future profit generation, because the AC, the fan, the TV help you to generate a profit in future. Okay, so something which help you to generate a profit, something that is your property, is called an asset. Clear? So what is asset? Now what is liability? Okay, what is liability? So liability is which create a burden on you, which create a burden on you, something that is obligation on you. Suppose for example, if you take loan from bank, then it is your obligation to pay the EMI in time, to pay back the money with interest to the bank. So you have a burden of paying the 1 lakh rupees, paying the suppose 10 lakh. So you have a burden to pay 10 lakh rupees plus interest. So it is the obligation on you. It is a burden on you. So that is called a liability. Okay. So take a screenshot if you want. Okay. So I hope that you understand what is asset and what is liability. Okay. Now now in budget, now if we talk about the budget, then first we have to talk some basic points. Okay, some basic points. So in budget there are two components. In budget there are two components. First, we can say it receipts. Okay, receipts. And second component is expenditure. What is receipts? We can say it income. Okay, the income portion in budget is called receipts. The expenses, the expenditure portion is called expenditure. Okay, so in budget there are two components. First is receipts and second is expenditure. Right? Now Now, receipts are of two types. Receipts are of two types. First is wait a minute. Okay. So first is revenue receipts and second is capital receipts. So first is revenue receipts, second is capital receipts. What is the meaning of receipts here? What is the meaning of revenue here? Revenue means on daily basis or monthly basis. Okay, so any income that government is generated on a daily basis or on a monthly basis is called a revenue receipts. Okay, I'm repeating this. Any income which government is generating on a daily basis and on a monthly basis is called revenue receipts. It's called revenue receipts. So revenue receipts have two types. Revenue receipts is of two types. First is tax and second is non-tax. Okay. So first is tax, second is non-tax. So the tax, what are the components come under tax? First is income tax, then GST, then excise duty, etc. So in the tax component we have income tax, GST and excise duty. Okay. So by income tax, government is getting income. What type of income it is? It is a revenue nature, which government get on a daily basis or on a monthly basis. That is we call recurring in nature. Recurring mean, what is the meaning of recurring? Recurring means in a daily basis, in a monthly basis or in a scheduled way. That is called revenue receipts. Or under this revenue receipts, we have tax. Okay, so from tax, we have three types of examples. That is income tax, GST and excise duty. Then non-tax. What are the things come under non-tax? First, we have fines. Okay, if you do not wear helmet and you are caught by policeman, traffic police, then you have to pay the charges, pay the fine. Okay, so the fine the money that you give the government as a fine is come under non-tax section. Okay, then any types of fees that government is getting, the government colleges, okay, the IITs that are government institutions. So from that institutions, government is generating the profit on a daily basis, on a monthly basis, or in a monthly basis, that we can call it a recurring in nature. Okay, so recurring in nature. So these are come under non-tax. What other things come under? That is interest received. Interest received. If government give loan to anyone, so on the behalf of that loan, government is getting the interest payment. Okay, so that is come under non-tax section, right? So this is our revenue receipts. Now we have capital receipts. What is capital receipt? Capital means, what is the meaning of capital? The capital means one time. Okay. Whatever income government is getting in lump sum in one time, that is we call capital receipts. What is the example of it? Like first, sale of assets. If government sell its assets, what are the assets? Like we can say it a railway. If government is planning to sell the railway, so government will get the lump sum amount from that railway. But in future, government will not get any amount from railway. It means that is one-time payment received by government as a income. So this is called sale of asset. In economics, the sale of assets is called disinvestment. It is called disinvestment, right? What are other things that government is getting on a lump sum manner? The thing is borrowing from bank. If government is taking loan from World Bank, from RBI, from any bank, so this is the lump sum amount the government is getting. So this is called a borrowing from bank, and this is come under capital receipts. Okay, so this is called capital receipts. Then suppose, so borrowing from bank, sale of assets. Okay, so these are the examples of capital receipts. Okay, so now 1 minute. Now tell me, if government is selling its asset, then it is called decrease in assets, right? We can call it the decrease in assets. If government is taking loan from bank, then we can call it increase in liabilities, right? We can call it simply increase in liability. Okay, so the question is asked like this: if government is planning to disinvestment, if government is planning to do disinvestment, then what we can call it? Decrease in asset or increase in liability? So we can call it decrease in asset, and it is come under capital receipts. Clear? So take a screenshot if you want. Okay, now continue. So this is the scenario of receipts. Okay, receipts, income. So we have seen two types of income, that is revenue income or capital income. Now we are going to understand the expenditure portion. Okay, expenditure portion. Now expenditure. expenditure. So we have two types of expenditure, right? We have two types of expenditure. One is revenue expenditure and one is capital expenditure, right? One is revenue expenditure and one is capital expenditure. Okay. So what is the meaning of revenue expenditure? The expenses that government is doing on a daily basis, on a monthly basis, or on a recurring basis is called revenue expenditure. Okay. So what are the things come under revenue expenditure? Tell me. So we can say that the salary that we are getting, that any government servant is getting, is comes under revenue expenditure, right? Because salary is given by government by monthly basis to all. Okay, so it is come under revenue expenditure. Next, pension. It is also come under revenue expenditure. Then scholarship. It is also come under revenue expenditure, right? Then interest payment. So interest payment of those amounts which government took from World Bank or IMF. So the interest payment is also come under revenue expenditure. Okay, then we can say that repairing work, okay. So if government made roads, railways, highways, national highway or metro, so repairing is needed on a daily basis, on the monthly basis, or on a recurring basis. So that expenditure is called the revenue expenditure. So it is the revenue expenditure. Now we have capital expenditure. Okay, so what is capital expenditure? The expenses of one time expenditure of the government is called the capital expenditure, right? So what are the expenses of government that is of one time? First is like creation of assets. If government is creating an asset, making an asset, like if government is making a road, highway, national highway, metro, or institution, university, so these are assets for the government. Okay, these are assets for the government. Now, next, if government is payment of loan, if government pay the whole amount of loan, then we can call it the capital expenditure, right? So many things can come under capital expenditure, but the condition is that it should be one time, it should be lump sum. Okay, so we can say that, so can we say that that if here government is creating an asset, then we can say that this is increase in assets. Okay, we can call it increase in assets. If government is planning to paying all the loan, so in future we don't have to give interest, or we don't have to give the EMI, provide the EMI to the bank. So the one thing is reduced from our head, that is the burden of paying the loan. So it is, we can say, decrease in liability. So it is called decrease in liability. Okay, I hope this is clear. Okay, so take a screenshot. Okay, now, so this is the basic. This is the basic. Now we are going to see the things. Okay. So what is budget? Okay. So what is budget? See, budget is the document. Budget is the document that shows, that is showing the income and expenditure. Okay, budget is the document that's showing the income and expenditure of the government of the country for a financial year. What is the financial year of India? Okay, what is the meaning of financial year? Financial year means from which date to which date we are going to take major business decisions. Okay, we are going to close, we are going to file the income tax return, we are going to close, file the GST. So this is called the financial year of a country. So of India, the financial year is from 1st of April to 31st of March. So of 2025's financial year is 1st of April 2025 to 31st of March 2026. This is the financial year of 2026. Clear? Okay. Okay. And one important point, in the constitution, in our constitution, the budget is called as an annual financial statement. Okay, what is the meaning? Okay, I am providing here. In our constitution, article number 112. Okay, article number 112. In article 112, wait. So article 112 in our constitution, in the article 112, budget is not mentioned. Okay, budget is not mentioned. So what is mentioned in article 112? In article 112, there is written annual financial statement. Okay, so we can call this annual financial statement as a budget, but in our constitution nowhere budget is mentioned. So this point should be kept. Okay, take a screenshot if you want. Okay, so going further. Okay, so if you are seeing this, all the tax that we are paying, this comes here and this will form the health, go in retirement or reservation or education. Okay, so what taxes we are providing, government will distribute this tax amount to us in return in the form of education, defense, health, infrastructure, and etc. Understood? Okay, going further. Okay, so here you can see the article 112 what mentions. Okay, that requires the president to present the budget. Okay, it is the responsibility of president to present the budget. But who introduced the budget in the Lok Sabha or Parliament? The finance minister. Okay, so okay, take a screenshot if you want. Okay, I am going to change the slide. Now budget and budgeting. What is the difference between budget and budgeting? Budget is the financial statement of receipts and expenditure of Government of India. Okay, Government of India's income and expenditures statement, final statement is budget. But in budgeting means the procedure which is followed by government to making the budget is called the budgeting portion. Okay, so budget policy or fiscal policy, we can call budget as fiscal policy. Okay, so there is no any issue. Okay, we can call it fiscal policy. Clear? Okay, now clearly we are seeing that the point is written here. Budget is nowhere mentioned in the constitution. Okay, in article 112 annual financial statement is mentioned. Okay, so who prepared the budget? Prepared the budget? Budget is prepared by budgeting or budget division of Department of Economic Affairs in the Ministry of Finance. So Ministry of Finance. Okay, so I can write this here, that budget is prepared by budget division. Budget is prepared by budget division. What is the name of the department who presents? Department of Economic Affairs, and Department of Economic Affairs fall under Ministry of Finance. Okay, it falls under Ministry of Finance. Clear? Okay, and financial year we have discussed 1st April to 31st of March, that is our financial year. Okay, and the first budget of independent India was presented by RK Shanmukan Setti in 1947. Okay, before 2017, the railway budget was presented separately from union budget. But in 2017, railway budget was merged with the union budget. So it is written here. In 2017, railway budget was merged with the union budget. Okay. Now, next. Okay, so same thing, na? Budget is not used in the constitution. Okay, we have discussed it. Okay, then the President of India ensure that annual financial statement is presented to the Parliament. It is the duty of President to ensure that annual financial statement is presented in the Parliament or not. Okay, okay, we have discussed it. Next, income and expenditure bill. Okay, so under the budget, government places both the income and expenditure proposal. Na? What are the incomes government is going to generate in future and what are the expenses will be required to do in our country? All of these are written under budget. So it is written here. Okay. And income related all the bills are called financial bill. Okay, so income related all the bills are called financial bill. Okay, called financial bill. Or expenditure related bill is called appropriation bill. Expenditure related all the bills are called appropriation bill. In this appropriation bill, grants and charged expenditure both are included. Grants and charged expenditure. What is grants and what is charged expenditure? Okay. So charged expenditure, what is the charged expenditure? Charged expenditure is those types of expenditure which is certain, okay, which is important, which is necessary, which requires no voting in the Parliament, is called charged expenditure. And grants require the voting of the Parliament. Okay, so you can see here, she is Nirmala Sitharaman, our finance minister. Okay, and these are the officers. So this is clear. I'm going ahead. Okay, now next next money bill and finance bill. Okay, so these are some important topics for your polity portion also, because budget is taught under both the subjects, polity and economics. Okay, so you can see here that money bill is mentioned under article 110. So remember it, that money bill is under article 110. Okay, and finance bill is under article 117. So these are the things. Okay, you can take a screenshot and read in your home. Next there is money bill and CFI. What is CFI? CFI means Consolidated Fund of India. Consolidated Fund of India. The one type of fund in which all the incomes of the government are stored. That is called Consolidated Fund of India. Okay, so I can give you some point here. Look, na? So if there is, this is one type of box here, that we call it Consolidated Fund of India. We can call it Consolidated Fund of India. So this is Consolidated Fund of India. And one type of box that we call it Contingency Fund of India. Okay, that is Contingency Fund of India. Contingency Fund of India. Okay, so these two types of boxes are there. One is Consolidated Fund of India, and one is Contingency Fund of India. Okay, so all the incomes of the government, all the income of the government will store here. Okay, comes under here. Okay, so the key of this Consolidated Fund of India is with Parliament. So with the approval of Parliament, you can withdraw the money from Consolidated Fund of India. So government is not free to withdraw the money in whatever way they like. No, in every single money that government wanting to withdraw from the Consolidated Fund of India, the permission of Parliament is required. So there is called money bill. Money bill is introduced in the Lok Sabha. On that money bill, that is written that much of money is required from this Consolidated Fund of India. Okay, so withdrawing from this fund is little bit difficult. Withdrawing from this fund is little bit difficult, right? So what is Contingency Fund of India? So Contingency Fund of India, one type of emergency fund. This is one type of emergency fund. This is one type of emergency fund. Okay, the key of this Contingency Fund of India is with President. President has the power to withdraw. So you know that President follows the advice of Prime Minister. So it is easy for the government to withdraw the money from Contingency Fund of India. Okay, but when government will get the money from CFI, so government will easily deposit that money into the Contingency Fund of India when government bill will be passed. So this is the fund that government has. So two types of funds are there. One is Consolidated Fund of India and one is Contingency Fund of India. Clear? Okay. So this is written here, and the frame of budget number. So okay, so remember this. So budget present number for 3 financial year. Okay, we have a budget, we have a numbers of 3 financial year. the first financial year, so the upcoming financial year, the financial year which is coming, the financial year which is coming, like our upcoming financial year of India is 2026. Okay, so 1st April 2026 to 31st of March 2027 is India's upcoming financial year. Okay, so first is upcoming, next is current. What is the current financial year? 1st April 2025 to 31st of March 2026 is the current financial year. And previous financial year, the previous financial year is 1st April 2024 to 31st of March 2025. This is the previous financial year. So 3 years, 3 numbers, that is upcoming, current and previous. The numbers should be available. Like upcoming financial year's data, we called it budget estimates. Estimates means what will going to happen in future, that is called budget estimate, and we are calling it, written it like this, BE. So if you study the budget of the government of India and you are able to see the BE written here, so you are now clear that BE means budget estimates, means upcoming. Okay, and the current year's budget estimates is called revised estimate. Okay, revised estimate, RE. And previous year's data is called actuals. So we can simply write that the 3 financial years data is required. Okay, 3 financial years data is required, because that is upcoming, that is called budget estimates, BE. Then current financial year, that we call it as a, and then we have previous, we can call it the actuals. Okay, actuals and budget estimate, actuals, and we can call it, this is revised estimate. Okay, so revised estimates. Clear? Okay, now so okay, clear. So this I taught you. Okay, so what are the types of budgetings are there? First type of budgeting is zero based budgeting, then gender budgeting, and then outcome budgeting. Okay, so these 3 types of budgetings are there: zero based, gender based, or outcome based. What is the meaning? What is the meaning of zero based budgeting? Zero based budgeting means doing the research from the scratch, making the budget from the scratch without taking the help from previous year. This is called the zero based budgeting. Okay, so zero based budgeting means preparing the budget from scratch or zero base. Each ministry must justify its expenditure demand as if there was no previous year budget. Okay, each ministry, if health ministry requires some money, so health ministry has to or should have to justify that their expenditure demand is going where. Okay, so this is called the zero based budgeting. So what is the goal of this this zero based budgeting? The goal of this zero based budgeting is remove unnecessary expenditure and promote professional, honest and merit based allocation. Okay, merit based allocation, right? Next, zero based budgeting we have done. Now we have gender budgeting. What is gender budgeting? Gender budgeting is the tool for gender mainstreaming in development. Okay, whatever the gender is being facing discrimination will be focus of the budget. Okay, so it ensures that benefits of development reach women as much as men. Okay, so the benefits of the budget will reach to each gender without discrimination is the target of gender based budgeting. Clear? Okay, going further. Okay, the simple example is zero based budgeting. Okay, if your income is $4,000 and your expenditure is also $4,000, so we can say the figure will come zero. When income minus expenditure zero, so this is called zero based budgeting. This is called zero based budgeting. Okay, next we have outcome budgeting. Outcome budgeting. What is the meaning of outcome budgeting? Outcome budgeting means whether government programs achieve intended outcomes, not just whether money is spent. Okay, whatever the programs or schemes government launched, the scheme or benefits, the aim of the scheme and benefits will go to the desired or needy people or not. This is the motive of the outcome budget. Example, for a hospital project, it check both construction and improvement of health condition in that area, that the what is the condition of health in that area where this budget was implied. Okay, so this is called the outcome based budget. Okay, next, so this was the fiscal policy. Okay, so fiscal policy means the identifying the government's expenditure and income. This is called fiscal policy. So what are the types of fiscal policies we have? We have first type of fiscal policy, that is neutral fiscal policy. Neutral fiscal policy. What is neutral fiscal policy? It means that government income is equal to government expenditure. Okay, if government income is 100 rupees, so government expenditure is also 100 rupees. So this type of budget, we called it, this type of fiscal policy, we call it neutral fiscal policy. Now we have expansionary fiscal policy. Expansionary. What is the meaning of expansionary? Whatever thing is expend is called expansionary. So see here, if expenditure is more, if expenditure is more than income, if expenditure is more than income, then we can call it a expansionary fiscal policy. And now we have contractionary fiscal policy. Whatever things are contracting is called contractionary. Okay, so what is the contractionary fiscal policy? When income is greater than expenditure. When income is greater than expenditure, then we can call it the contractionary fiscal policy. Okay. And this contractionary fiscal policy is seen in developed countries like USA, Japan, South Korea. These are the countries. Now what are the structures of the budget? Okay, so we have studied this, that union budget is divided into revenue account or capital account. Okay, so revenue accounts have revenue receipts and revenue expenditure, and capital account is capital receipts and capital expenditure. Okay, we have seen this. Now revenue account, okay, I have told you all the things, so no need to read these things. Okay, I have already told you that in the revenue receipts we divided the tax and non-tax revenue. Okay, tax revenue, there is revenue, income tax, corporate tax, GST, excise duty, custom tax, service tax. These all are comes under tax based, and non-tax based include fees, fine, interest on loan or dividends. Okay, so these are the things. Next, revenue expenditure. In revenue expenditure, it means day-to-day running of the government, the expenditure on day-to-day running of the government. Okay, so what are the revenue expenditures? Example, that is salary, wages, pension, law and order maintenance, civil administration, or grants to the state, subsidy, interest payments, and defense. These are the things. Next, going further, capital account. Okay, we have seen that once in a while, the things which is once in a while, the one-time things is called capital nature. Okay, so capital receipts we have loan. Okay, loan and borrowings, and then sale of government company, that is called the disinvestment, or sale of government assets like land and buildings, or recovery of loan given earlier. These are comes under capital receipts. Next we have capital expenditure. In capital expenditure, usually we see that there is a creation of asset or reducing of liability, like the creation of infrastructure is increasing in asset. Loan to state government, okay, providing loan to state government, it is also increasing asset because the state government will return the loan amount in future. And repayment of loan, if we repay the loan of the bank or anyone, then that is the decrease in liability. Clear? Okay. Okay, so now the most important concept is revenue deficit. What is revenue deficit? Okay, so the formula of revenue deficit is revenue expenditure minus revenue receipts. So revenue deficit means revenue expenditure minus revenue income or revenue receipts. This is the formula. Revenue deficit equal to revenue expenditure minus revenue receipts. Okay, so this revenue deficit, what shows? It indicates whether daily government operations are financially sustainable without borrowing. Okay, so government is able to work in a daily basis without borrowing or not. It is showing in revenue deficit. Revenue deficit. Now, okay, I have discussed. Next we have fiscal deficit. What is fiscal deficit? Total amount of money borrowed by the central government in a year to meet revenue and capital expenditure. It means fiscal deficit formula is total expenditure minus revenue receipts plus non-debt creating capital receipts. Okay, we have to exclude the borrowings. We can't take borrowings in this calculation. If we less the borrowings from here, so it is called the fiscal deficit. So what is the formula of fiscal deficit? Fiscal deficit, we can simply tell that total expenditure of the government minus total income, but we can't consider the income from borrowing, so we have to subtract this borrowing portion and we will get the fiscal deficit. Okay, so this is called fiscal deficit. This is called fiscal deficit. Clear? Now we have effective revenue deficit. Effective revenue deficit, what is ERD? effective revenue deficit means this concept was introduced by Rangarajan Committee on Public Expenditure. Effective revenue deficit means revenue deficit minus grants to state government. Okay, whatever the grants are provided to state government, we have to subtract this from revenue deficit. We will get effective revenue deficit. Effective revenue deficit. Okay, effective. Okay, so effective revenue deficit means revenue deficit minus grants to state government. It's called effective revenue deficit. What is the purpose of effective revenue deficit? To deduct the money used from borrowing to finance capital expenditure. Okay, so remember the formula. This is important. Now we have primary deficit. What is primary deficit? Primary deficit. Okay, primary deficit means fiscal deficit minus interest payment. Whatever the interest payment we have, government has done, will be subtracted from this fiscal deficit. We will get primary deficit. So primary deficit means fiscal deficit minus interest payment. This is called fiscal deficit. Take the screenshot if you want. Now going further. So now we have the concept. Okay, so these are the formulas we have learned. Revise it. The very important formulas are there. So now we have deficit financing. If there is less money available to government, then what government can do to expense to go with the daily operations of the government or the country? So what measures the government can take to finance the borrowings, to finance the less money supply in the hands of government? So we have the deficit financing. Deficit financing, we can call it the monetized deficit. What means? Government's practice of covering financial shortfall by borrowing directly from the central bank. Okay, government can finance the shortfall of income by borrowing from central bank. Government can borrow from central bank to finance its daily expenditure. So this is called deficit financing. Two methods of government borrowing. There are two methods of government borrowings. First, market borrowing means from bank and financial institution. Or second, central bank borrowing means RBI. So RBI can create new currency, but creating a new currency or printing new currency is so dangerous because it can create the inflation in the market. So in India, this is avoided by the government. This is avoided by the RBI also. Okay, this is not the solution to finance the deficit. Okay, so this is not the correct way. So how monetized deficit work? Government borrow from Reserve Bank of India. RBI generate new currency to lend to government, but this is not the right idea. Fresh money is injected in the economy and this increase the money supply. Okay, if you print more and more money, then it will create the inflation situation, and the inflation situation is very bad for any country. So it can't be done. Okay, so important note, what is here? Indian policy monetized deficit is not allowed in India. Monetized deficit means printing a new currency for financing the deficit is not allowed in India. And government must meet its deficit through market borrowing. If government has a shortfall of money to finance the daily basis expenses, then government can take it from market or not by printing money. So thank you for watching this video, and you can join us with this. You can join us with Telegram, Facebook, Instagram, and YouTube. Okay, our channel name is RCA Education. So you can join it, and you can share this video and like this video. Okay, till then, thank you so much. Thank you so much. Okay, so this was the fiscal policy. If you want any further videos, then please comment. I will make those videos in sure. Okay, thank you for a while. Thank you.